All right, let's talk about something really interesting that's happening right now in the world of retirement planning. We're calling it the Goldilocks zone of 2026. Today, we're going to break down exactly why this specific year is shaping up to be a pretty unique opportunity for a financial tool called the Fixed Indexed Annuity. So let's get right into it. So here's the question that keeps a lot of people up at night, right? You've worked your whole life to build this nest egg. You absolutely need to protect it from those wild market swings, but at the same time, you need it to grow so you don't lose ground to inflation. It really feels like you're walking a tightrope, and the stakes couldn't be higher. And that's where this idea of a Goldilocks zone comes in. We're talking about a special moment in time where a few key economic factors are coming together to create an environment that's, well, just right. It's not too aggressive and risky, but it's not too slow and conservative either. It might just be the perfect temperature for retirement in 2026. So here's the plan. First, we're going to define what this Goldilocks zone actually is. Then we'll dig into the three pillars that make it so compelling: the growth potential, the cost structure, and the peace of mind. And finally, we'll look at why this really is a limited time window. Okay, so let's dive right in. What is it about 2026 that makes it so special? What's behind this just right moment? Well, you've got this perfect storm brewing. On one hand, the market is all over the place, which has retirees laser-focused on protecting what they have. But on the other hand, it looks like interest rates are starting to dip, and that means those traditional safe havens like CDs and bonds just aren't going to pay what they used to. So you have this classic dilemma. The need for safety is clashing head-on with the need for growth. Now get this. Every single day, an average of 11,200 Americans are turning 65. This is a massive demographic wave, sometimes called peak 65. And with that comes this absolutely unprecedented demand for solutions that can provide a secure retirement income. And that massive demand is leading more and more people to something called a fixed indexed annuity, or FIA for short. You can think of it as a hybrid. It's an insurance contract that gives you total protection for your principal, so you can't lose money from a market downturn. But it also gives you the chance to grow your money by linking it to a market index, like the S&P 500. It's designed to give you that balance of safety and growth. All right, so let's get into the first big pillar here, growth potential. How do you actually make money with these things without all the usual risk? This is the absolute bedrock of an FIA. It's called the 0% floor. And it's simple. You just can't lose your money because the market goes down. Period. If the index has a bad year and goes down 10, 20, 30%, your account value doesn't lose a penny. It just stays put. Okay, so if you can't lose, how do you win? Great question. It usually comes down to two flavors: cap rates and participation rates. A cap rate is just a ceiling on your earnings. If the market goes on a 15% tear but your cap is 12%, you get a fantastic 12% return. A participation rate means you get a slice of the market's gain. So if the market goes up 10% and your rate is 80%, you get credited with an 8% gain. See the trade-off? You give up some of the massive home runs to completely eliminate any and all strikeouts. And this is why we're talking about a Goldilocks moment: 12%. Because interest rates have been higher recently, insurance carriers have been able to offer much more attractive terms. For years, caps were often in the 6 to 8% range. Seeing them as high as 12% is a huge deal, especially when you remember that it comes with zero downside market risk. Okay, on to pillar number 2, the cost. Now, let's be honest, annuities have a bit of a reputation for being complicated or pricey, but we need to clear the air on how modern FIAs actually work. And here's the thing that really surprises people. The basic FIA contract itself, it usually has zero annual fees, no management fees, no administrative fees nibbling away at your account value every year. The principal you put in is protected and gets to go to work for you. So where do fees come in? They come from optional add-ons called riders. Think of it like customizing a car. The base model is great, but maybe you want to pay extra for heated seats or a better sound system. With an annuity, you can choose to add riders for things like a guaranteed income you can't outlive or better benefits for your kids. So, at the end of the day, it's all about tailoring the contract to be just right for you. You only pay for the extra features you actually want and need. It's a transparent way to build the exact combination of benefits that matches your financial goals. And that idea of solving for specific worries, that takes us right into our third pillar: lifelong peace of mind. This isn't just about numbers on a page. It's about taking care of the people you love. One of the most powerful features for couples is something called spousal continuation. It's a really elegant solution to a common worry. What happens to my spouse financially when I'm gone? This feature allows your spouse to just step into your shoes as the owner of the annuity, keeping the payments and all the benefits going without a hitch. And here's how simple and powerful it is. You set up a joint life annuity. You both get income for as long as you both live. And then, when one person passes away, the income just keeps flowing to the surviving spouse. No interruption, no hassle, just a continuation of that financial security when it's needed most. Okay, we've talked about why things are just right. But here's the catch. Perfect moments don't last forever. Let's talk about why this window of opportunity is starting to close. Take a look at this. 2024 was a massive year for annuity sales, fueled by those high interest rates we talked about. But look at the projections for 2025. Still huge numbers, but they're starting to dip a bit. That's a strong signal that the peak of this high-rate environment is probably in the rearview mirror. And don't just take my word for it. Here's a quote from LIMRA, a major industry research group. They're basically saying, hey, as interest rates fall, expect those awesome cap rates and participation rates to fall right along with them. It's a direct cause and effect relationship. And that really brings it all home. 2026 is this incredible sweet spot. You've still got the chance for really attractive growth, but you're also in a market where protecting your principal feels more important than ever. That's the Goldilocks combo. And as rates continue to fall, that growth side of the equation is likely to get less and less attractive. So I'll leave you with this question to think about. In a world that feels more volatile every day, what's a guarantee really worth to you? What is the value of knowing that no matter what the market does, your principal is safe and your income can last for the rest of your life? All right, that's what we have for today. I really hope this look at the 2026 Goldilocks moment gave you some food for thought. Thanks so much for watching, and definitely subscribe for more deep dives into your financial future.